So if we merely match those two prior bull markets, gold would be like 8,500 or something. Now, we're not projecting that as a target. We're just simply making a point that people who think gold is overvalued don't realize that on a percent gain basis, no, it's not. And we certainly have technicals and fundamentals that are far more potent this time around than were in play back in 1980 or 2011. I frankly think we're going to go way past 8,000, and probably in the next year or so. In other words, you factor in M2 growth, how much quantity of money has been created, printed, over from 1980 to 2011 or 2011 to the present. Silver would probably be, $500 just to match those highs in terms of decay in the money unit.
Michael Oliver explains that silver has decisively taken the lead in the current precious metals bull market, marking a clear shift in market behavior after years of underperformance relative to gold. While both metals advanced strongly in past cycles, silver spent several years lagging even as gold continued higher. That changed recently when the silver-to-gold relationship broke out of a long, deeply compressed base, a technical development that signals a new phase where silver begins to outperform. This leadership does not imply weakness in gold, but rather highlights that silver, after years of being undervalued, is now asserting dominance as investor focus broadens within the monetary metals space. Michael Oliver places particular emphasis on the breakout in the silver-to-gold ratio, noting that it emerged from historically extreme lows not seen often over the past half-century. Once that ratio turned higher and confirmed a breakout, it sent a clear message that silver and silver-related assets should be emphasized. In his view, silver is now positioned to gain value at a much faster rate than gold, potentially doubling its relative value even as gold itself continues to rise. This shift mirrors previous cycles where silver lagged early, then surged aggressively once momentum and market psychology aligned. Looking further ahead, Michael Oliver argues that silver's long-term price structure suggests the potential for a dramatic revaluation. He compares silver's decades-long consolidation to historical examples in other commodities that remained suppressed for years before breaking out and rapidly moving to entirely new price ranges. In those cases, once the ceiling broke, prices advanced multiples in a short period of time before stabilizing at much higher levels. Silver, having been constrained far longer than many comparable metals, may not only move quickly but overshoot before settling, implying that the next phase could be both explosive and swift, unfolding over months rather than years. Now, we present the clips from Michael's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
Silver relationship to gold is also been subdued, like this chart here, especially since 2020. Remember, both metals had a big surge in 2020, from early that year through later that year. Silver doubled in price from 15 to 30, and gold went up 40%. So silver beat gold on a percent basis. But since 2020, silver's performance to gold has languished. It's pulled back. So have the miners versus gold. Now, that doesn't mean they were going down. It just meant they weren't going up as much as gold was, okay? But that started to change. And early this year, silver started to really ramp on the upside. It's a signal we put out to our subscribers based on other technicals. And the performance upticked. And on the November close of the spread versus silver versus gold, you also had a breakout of a multi-year base. So not only did gold say, hey, I'm on top of the game versus the stock market, silver said, now I'm going to outpace you, mama metal. Silver is coming up from depths. And its depths are pretty deep, meaning you got down as low as 1%. Divide an ounce of silver to an ounce of gold. And if you go back 50 years, that's low. It's been there before, but that's it. That's the low, okay? And we've now since surged, and it's broken out as of November. Now, back in November, where did silver actually close in price? $56. Okay, 2 weeks and a day into the new month, we're $64. Wow. Okay, something happened, and it wasn't just that silver was going up. It's been going up for a couple years, like gold, right? Okay, but the spread broke out, and once that spread broke out, it told us if you're going to go into monetary metals, emphasize silver and silver miners. Doesn't mean the gold miners are no good or gold's no good. It just means silver and the silver miners, which have been languishing and vastly undervalued compared to their peers, are now ascending, and they're going to be on the top. And that's what's happening. And we think silver at minimum is going to at least reach 2% very quickly of the price of gold, meaning from where it was at the lows back like in April, it's going to double in value relative to gold. Not double in price, double in value. So, and the gold's going to be going up during that time. It has been. But silver's going to outpace it. Now, there's another chart that might help you in that regard. Flip the page one more here. No, another one. There you go. This is gold going back to when it was legalized. At $200, it dropped down to 100 back in 1976. And then from that 76 low to the 1980 high, that's the first up arrow in the horizontal. That's an 8-fold gain. This is a ratio chart, logarithmic scale. It's not a point scale. Then you made a low in 2001 and 2, or 2001 I think it was exactly, $265 or so. And you had another major surge over a lengthier period of time, but the same dimension move, an 8-fold gain up to the 2011 high. And then you had the pullback to 1,050 on gold, and then you labored for a couple years, and finally you took that out in 2020. And you're now at where? 4,000 plus. Well, the bear low was 1,050. We're only 4-fold gain in this bull trend. So the people who say, hey, gold's overdone. Well, it isn't even matched. It's only halfway the dimensionality, percent gain that we saw in 1980 and then we saw at 2011 peak. So if we merely match those two prior bull markets, gold would be like 8,500 or something. Now, we're not projecting that as a target. We're just simply making a point that people who think gold is overvalued don't realize that on a percent gain basis, no, it's not. And we certainly have technicals and fundamentals that are far more potent this time around than were in play back in 1980 or 2011. I frankly think we're going to go way past 8,000, and probably in the next year or so. In other words, you factor in M2 growth, how much quantity of money has been created, printed, over from 1980 to 2011 or 2011 to the present. Silver would probably be, $500 just to match those highs in terms of decay in the money unit. But anyway, this chart is broken out, but if you just take a simple measurement, and again, this is an idiot rectangular measurement. The lows were like $4 or $5, the range, that 50-year range, and the highs were 50. So let's call it $45. So we're talking about, we're going to go up to, on an arithmetic scale, you go up to 100, but on a ratio scale, that's a 10-fold dimension rectangle. You broke out at 50, that says you go to 500 to match the depth, the thickness of that range that you just broke out of. We think silver is going to do something extremely dramatic, and it's going to do it in the next handful of months. Why? Not just because this breakout has occurred, but we've studied many other markets that have done similar things. I'll give you an example. Copper, back in from 1970, 80, 90, 2000, up through about 2005. So for multiple decades, lived in a price range at a very low level, like either side of $1.50, okay? Up and down, up, just like this range here. But it was about 30, 40 years wide. But at a very low level. And when it broke out of it in late 2005, early 2006, it quadrupled in price in a matter of 2 or so quarters. 2 quarters, you quadruple price up to 450. Yeah, you had to sell off after that, but they've lived in a range now, we're starting to emerge above that recently, that is 4 times the average price of that range that existed back in 1970, 80, 90, 2005. You cut through the middle of that range, you've lived in a range 4 times the price level of that, but the shift to the new reality was so fast, took your breath away. Then we also found a chart of lead, exciting metal, right? Lead, okay. Same story. It lived in a range, 70s, 80s, 90s, 2000. In 2007, different from copper, year and a half after copper made its surge, lead broke out of a similar dormant range, and it quadrupled in price in a matter of a couple quarters, and lived in a new reality since. How come silver's been caught in this box for 50 years, whereas lead and copper zoomed 4-fold out of a range that was okay? Well, there's arguments that are valid that it's been artificially contained by government efforts, banks in coordination with the central bank trying to keep it restrained. Whatever the excuse, it's been restrained. And quite often, as we know in market history, when a market does something in excess one way and corrects for it, it quite often overcorrects, and it does it quickly. This is why sometimes stock markets crash, okay? Similarly, when a market is depressed for too long and made a mistake, so to speak, not all markets are rational, remember, okay? That's a false assumption. Then it goes to a new reality, and often it'll overshoot where that reality might ultimately, on average, be. Like the copper move to 450. After that, it dropped back and lived below that level for quite a while.
Recent market action is signaling a deeper transformation beneath the surface, one that goes far beyond short-term price moves in gold or silver. Michael Oliver explains that November marked a critical turning point, not because metals simply rose, but because gold decisively broke out in performance relative to the S&P 500 after more than a decade of sideways behavior. For years, investors could choose either stocks or gold and achieve similar results, but that equilibrium has now fractured. This breakout reflects the early stages of an asset class rotation, indicating that gold is beginning a sustained phase of outperformance rather than nearing exhaustion. Michael Oliver emphasizes that these relative performance signals matter more than headline prices because they track where capital is actually flowing. The same breakout pattern is now visible in gold's relationship to the Nasdaq, the Dow, and broader equity benchmarks, reinforcing the idea that this shift is structural. As equity markets struggle to generate real returns and volatility increases, capital is gravitating toward monetary metals. Given the size and duration of the base that preceded this move, Oliver believes the trend has only just begun, with gold positioned to strengthen its lead as investors increasingly reassess risk and long-term value.
The mama market of the monetary metals. And so far, over the last 5 decades, it's been a leader, okay, in terms of dimension of gain since 75, when it was 100, and 76, it had a corrective low at 100. Start from there, we're 4,400, okay? You do the math. But something big just happened in November, and it wasn't up in gold or up in silver. Yeah, that happened. But that's been going on for a while. Gold's been in a bull market for a while. But something new happened, and that is that an asset class shift was signaled. Meaning, the chart on page 4 of my weekend report, if you can pop that one up, it shows what we call a spread relationship between gold and the S&P 500, meaning at the end of every month, we plot where's the front month contract of gold divided into the S&P, express that as a percent. Okay. And we know in 2011 gold peaked, and in 2013 it particularly started to collapse toward the 2015 price low. And in that process, its performance relative to the S&P was also dropping. Okay. And so the top chart on page 4 shows that spread collapse. Where we were dropping from like 80% gold versus the S&P to down to close to 50 at the end of 2015, which is when gold actually made its price low. But then since that 2014-15 period there, where it dropped down near 50% of the price of the S&P, you could draw a line sideways if you want to. And we've been oscillating either side of that. But actually there's been a slight gradual downtrend line on the spread chart. A technical feature, okay? And you can see 1, 2, 3, 4 rallies. Back in April, we hit that line again and dropped back, April, May, June. And then in November, last month's close, gold closed on a spread basis, relative performance, out above that structure, meaning I'm breaking out. Okay, now, this is a beginning sign. This is not what happens late in a trend. This is saying, hey, you think you've seen a bull trend to date? It's just beginning. Because the asset class shift is commencing now. It's no longer a duel between gold and the S&P, which basically has been sort of oscillating sideways for 10 years, where whether you bought gold or S&P, it did about as well. Okay, gold's now saying I'm gonna beat the S&P. I'm gonna head into a trend. But given the size of this base, 10 to 11 years wide, and the depth of it, you're not going up for a month or two on this performance. You're going to go up for a couple of years probably. But it just broke out. So that the people that think, hey, gold's been going up too long, it's got to go down some, got to correct. This technical indicator here says, no, it just began. And then when we plot gold versus the NASDAQ 100, which is, the AI stock, it's also breaking out. So gold's breaking, and versus the Dow and the New York Composite, gold already broke out months ago. So what it's saying is if you're going to invest in an asset category, which one, stock market or gold? It says start now, gold. The game just started. Anyway, very informative charts, I think. Spread charts are very predictive, not just whether they go up and down. And any chart oscillates, up and down. The price charts, that doesn't mean anything. So gold's had some surges in the last 10 years. You can see them on the spread chart. They go up to that green line and fail. But this is a breakout. Now, whenever we find breakouts on spreads, and what we like about spreads in particular is most people don't look at them. Most people just look at a gold chart or an S&P chart and say, oh boy, look, it made a new high, whatever. It's the relationship between the two that says money flow is now going to go more into gold than the S&P. And as the S&P wobbles around some more, and it's gone nowhere for 3 months, and it's only like 10% or 11% higher than it was beginning of late last year's close. Whereas gold's up enormous percent since last year's close. But the spread is informing you this is a technical shift of sizable quality. And you don't get them that often. I mean, you get ups and downs all the time, but you don't get a structural breakout like this that's so clear that even a 5-year-old kid with a crayon on a ruler could plot it. It's in your face, okay? So, but again, the virtue of this, and we do spread analysis quite often in addition to our momentum structural analysis, but spreads are not a common tool. And that's good because that means not everybody knows about it.
Yeah, well understood. And you're kind of plotting a capital rotation into from the SP 500 into gold. How can the spread actually go?
If you just want to take the dimension of that base there and treat it like a regular price chart, you got a line up there at 60% you broke through, and you got lows under 40, so you could go. We're going up to 80% of the value of the S&P, but that's not necessarily the case. That's just a simple minimum swing objective. But it's broken out, it's fresh, and it's massive. So it's not a trivial signal. And it's also a beginning signal. So those who think that the monetary metals have had their party, it's just begun. Because when that stock market continues to fiddle around like it's been doing, in other words, not really making money, or if it rolls over, as we argue it's going to early next year, and then people get shaken up, even more money will begin to flow out of the stock market category into that which is working. And already some asset managers, it's clear by this chart, have realized gold is working, okay? And they're moving already.
What comes next for gold and silver appears to be a phase where momentum shifts from quiet accumulation into broader participation as capital continues rotating away from overstretched financial assets. Gold is likely to strengthen its role as a benchmark store of value rather than merely a defensive hedge, with sustained upside driven by persistent currency debasement, expanding debt burdens, and declining confidence in real returns from bonds and equities. Instead of sharp, isolated spikes, the more probable path is a series of advances punctuated by brief but intense pullbacks, each correction serving to reset sentiment before the next leg higher. Silver's outlook is even more volatile, but potentially more dramatic. Having lagged for years, it is positioned to accelerate once investment demand converges with tight physical supply and rising industrial usage. In such environments, silver historically outpaces gold, not smoothly, but in fast, disorderly moves that catch markets off guard. If gold continues to climb while monetary conditions remain loose, silver could compress years of underperformance into a much shorter time frame, producing outsized percentage gains that redefine its role from a secondary metal into a primary driver of the precious metals cycle. As confidence in paper assets weakens and capital seeks tangible value, gold and silver may shift from being optional allocations to strategic necessities. So the real question is, will the next surge leave most investors watching from the sidelines or positioned before the acceleration truly begins? If you found this insight useful, make sure to like, share, and spread this update to others watching the silver story unfold. Your support helps keep these deep dive analyses coming.